On today's show, 3 questions. Number 1, where is the ceiling on tariffs? Number 2, is $1 million still a lot of money? And number 3, is the 60-40 portfolio dead? Welcome to Dentist Money's 2 cents, where we have dentists navigate all the noise. I'm Matt.
And I'm Rabih.
Yeah, you are. Rabih, we teased it last week. We thought we're kind of, this show, I feel, is a little bit right now like we're matching Utah's weather, which is like we act one way and then go the other way. So last week we had Jake on and we're like, guys, we're back, the trifecta. We're bringing 3 people back. And then here we are back to 2. We are storming again. The snow is back.
Yeah, deal with the weather.
Yeah, here we are. So we're doing a little bit of a special episode. We're actually recording this on Wednesday this week as opposed to Friday. It's my fault. I'm headed out back east tomorrow I'm doing an all-day workshop. Rabih, I'm speaking for 6 hours.
Nice.
So I think we could probably do that too. I think we could go do a 6-hour thing together. I feel like.
What's that senator's name that just broke a record on the longest speech? He's not better than us.
Wait, what? I did not hear this.
I think it's Cory Booker.
He spoke for how long?
Like 25 hours, nonstop.
Wait a second. Wait, he was filibustering or what?
Yeah, I think so.
Okay, I did not see this. That is wild.
It was all over my social media this morning.
Well, that is wild. Just because I'm not really on social media. That's probably why I didn't see it. I'm going out with our beloved Jordan Haynes. So we're going to tag team. So now I feel like kind of a piker doing 6 hours with someone on the team. Cory Booker did 25 hours straight. That's pretty wild. I don't think I'd have 20. So he was awake for 25 hours straight.
I guess so.
We got to look into this.
Yeah, like where does sleep go in? Where does bathroom breaks go in?
Okay.
I would want to learn more about that.
Okay, we're doing this really quick. Finally, some fire. Cory Booker, 25-hour speech strikes a chord at home. Broke a record, 25-hour Senate floor speech. How dehydration helped Cory Booker survive his 25-hour Senate speech. What is happening? Okay, well, I'm going to have to look more into this. Let's jump in. Rabih, where's the ceiling on tariffs? This is the new theme. This is going to be the new theme. Clearly, it's just tariffs is the new inflation, basically.
100%. And I feel like by the end of the tariff cycle, all of our listeners will have probably a master's degree in economics because
we listened to you long enough. Yeah,
we need to go that far into it. But yesterday there was a release from the White House economic correspondents and advisors that the tariffs that the administration is imposing might bring in around $700 to $800 billion. Which was really good numbers. Then other economists showed up and was like, no way, it's barely going to break 500 billion because there's going to be retaliatory effects, etc. So I found it very interesting that this is the debate we're having in Washington and Wall Street right now. It's like how much money the tariffs are going to bring in. And if that's not the amount of money that we need, can we put on more tariffs? So I wanted to take a step back, navigate the noise a little bit, and try to adopt a framework more about the structure of the economy and what is allowed and what is not allowed. And we know that the economy works in balances. So just like when unemployment shoots up, there are mechanisms that rebalance the economy into a certain equilibrium, aka interest rates. There has to be something related to tariffs, to trade deficits, to the trade balance, that actually puts the economy on the right track and kind of gives us an upper limit. I felt that this would be more of, imagine you're a bowling ball, you're going all the way, but there are bumpers on the side. And we're trying to define what these bumpers are just to feel better about it. So I wanted to give you a little bit of background about the deficit, and let's see structurally whether it makes sense to get rid of it. But before I get there, just to narrate the rhetoric that the administration is coming with. It's plausible. In economics, everything is plausible. But the idea is the US government is in a deficit around $1 trillion a year. And what we're talking about a deficit, we're talking about the budget deficit, aka the government spends $1 trillion more than it makes in a year. And also, on the other hand, we have something called the trade balance, not the budget, but the trade, which is about imports and exports. And imports and exports stuff says that we import a little bit around $1 trillion, then over a little bit of $1 trillion over what we export. So our trade is in deficit for around $1 trillion. So the idea is if we can impose tariffs and bring down those imports down, that would kind of cancel out the deficit. That's the theory. So we have a trade deficit in some place and we have a budget deficit, both of them. If we try to increase tariffs to eliminate the trade deficit and bring trade into balance, that extra money can go into the budget and balance the budget as well. Two birds with one stone. The stone would be the tariffs. Noble cause, aside from how the economic machine works. But I wanted to give you some data to look at it. So in 2020, US imported approximately 1.2 trillion more in goods than it exported. That's what we were talking about. But if you include services, the deficit was 918 billion. So we actually export more services and we import more goods. That is the type of situation we deal in. In 2025, January 2025 alone, the monthly international trade deficit increased significantly by 98 billion. So around 10% of what we do in a year. It happened only in 1 month.
Wow.
It increased from 98 billion to 131 billion as imports surged more than exports. And this is actually a very interesting observation. We were looking at the GDP for the last, the Atlanta Fed GDP now, and we saw that the GDP suddenly took a turn because imports exploded. And we were saying, oh, businesses are trying to get ahead of the tariff deadline, which is today, and try to import ahead of schedule before those stuff get expensive to them. So the whole idea of imposing tariffs to curb down imports actually accelerated imports before the deadline for it.
It was like the country's version of doom spending. We're seeing as at the individual level. This is now happening at the government level, or the economic level,
at the business level.
Business level.
So it is very interesting that you want to push the policy in one direction. The market reaction was the complete opposite, which increased imports. But hopefully now that the tariff deadline has come through, all of this exuberant activity will calm down and the policy will take effect. In a sense, this is where we stand.
If anything, sorry, Rabih, if anything, that shows how serious everyone thinks the administration is about this. Meaning, I think when this all kind of started, you and I were speculating, I think a lot of people were speculating, which is, was this a negotiation tactic? Is this posturing? Which I think for a while, everyone kind of thought that. And then as time's gone on, to me, this activity from these businesses of like these rapid import increases just says everyone's believing now this is serious. Like this is actually happening.
True. Yeah, it turned into an economic policy. We want to get rid of that trade deficit. We want a balanced trade. Let's jump a little bit into theory to see what the pros and cons. Let's define one of the first bumper out of these two bumpers that we're going to talk about. The first one is like the argument for why you need to curb trade. Can you hear all the bumping and noise? Okay.
A little bit, not bad.
Okay, so we'll cut that. Sorry, Stuti. Sorry, Misha. Okay.
We love you. Sorry, I'm cringy.
So let's start with the first argument for why we need to curb the trade deficit and bring it into a trade balance. Kind of the first bumper out of these two bumpers. And usually it's politically motivated, but like the textbook tells us that one, it leads to foreign ownership of domestic assets, which increases vulnerability of capital flight. And let me explain what that means. What that means is that if you're a country that does not produce anything and all you do is import, is that you really depend on other countries' products for you to consume and to survive, which is true. But once you do that, what is happening? When you go out as a US citizen buying a foreign product, the money transfer that happens is that now the foreigners who sold you the product have lots of US dollar. And they usually buy with them US treasuries and for US assets because they got money in dollars. The risk over here is not only you're dependent on them, on their products for you to consume, but also they have money that they can move around. And if they decide to take it out of the US system or just sell those treasury bills or sell the US dollars, that will impact you negatively. So the fact that a lot of money is flowing out of the country gives those outsiders some power on the economic path that your country is on. So in textbook wise, this is why it's important to kind of curb down
exports. Or sorry, I guess
the imports.
Imports, yeah. So cash going out,
import.
Goods coming in.
100%. The second one is to actually support your exports, the other one. And I think we hear this a lot. This is not something new, but every political candidate talks about the Rust Belt and how the automobile industry has been transferred out and the domestic industries that were in place actually took a hit and they're not as competitive anymore. So trying to impose tariffs to balance the trade kind of is, in a sense, theoretically, to help the domestic industry. And also, there's always the national security concern. We will take that for what it is. And the last one is that it is a trade deficit is a drag on the GDP. We know that the GDP is composed of consumers, businesses, the government, and the difference between net exports and imports. An export raises GDP, an import reduces GDP. So a trade deficit means no more imports is a drag on the GDP. So this is the argument for why would you want to do it. But, and here's where the caveat is, here's where the second bumper comes in, here's where my personal opinions and hot takes come in. This applies.
I love the Rabih hot takes, yes.
This works on a single, very reduced economic model of a certain country equal to all other countries on the globe. But this is the US we're talking about over here, which is different because the
America.
US, yes, we can go that route. But the other route is that the US is the global currency reserve of the world. And this is going to be very interesting because now we're going to connect tariffs and trade deficit with the power of the US dollar and how the US can maintain itself as, the global currency, the reserve currency of the world. And here's why I'm going to tell you my hot take, in my opinion, according to the numbers I'd run. It is kind of impossible on the long run to get rid of a trade deficit. Putting the politics aside.
You're saying as specific to the US, it's
as
impossible?
Specific to the US, it is.
Got it.
It is kind of impossible because right now I'm just going to look at the structure of it. I'm going to give you these numbers and we'll go from there. The US share of global GDP, aka what's the size of the economy as a part of all the largest economy, is 20% if you convert all economies to US dollars. But if you convert them according to purchasing power, which is what's your citizens' ability to consume the local products, the US size as part of the global economy is 15%. This is the size of the US economy. Decent. We're not saying anything about it.
Yeah.
But if we zoom in on the US consumer, which the US consumer is 70% of the US economy, right? We know that. If we zoom in the US consumer and we compare it to other consumer, the US consumer alone, household consumption, accounts for nearly 30% of global consumption.
Ooh,
so
okay.
American households consume almost a third of what the entire world produces. Think of it that way. The US consumer consumes a third of what the whole planet produces. That's a big, big, big number.
That's huge. One thing we continue to reinforce on this show is how much Americans like to spend money.
True.
It's unbelievable.
So if you think of it, the US is not the factory of the world anymore. We know that. But it is the customer of the world. And if you are in a system where your identity is to consume, it means that you are going to be running into a trade deficit. There is no way you can have 30% of the consumers decide to stop buying from the rest of the world. Like how does that work? To give you more data, I have him here. Let me pull them up.
I'm going to get a t-shirt that just has your face on it. It just says, I have some data.
I have some data. So the data is, if you decide to curb consumption, you will have to change either the national policy, the cultural spending in the US, or just the whole system. AKA, you need to bring back America as a factory of the world rather than a consumer of the world. How likely is that? Theoretically, it is very hard. And
that's what Trump's has run on, right? I mean, that's kind of one of his main things is he wants to, I don't know if he's talked about this specifically, and whether or not it's going to come to fruition. I think that's kind of one of his biggest pushes has been with the tariffs is how do we get factories and kind of these blue collar type structures back in the US like it used to be. That's his whole push.
True. But this will require new jobs to be created, right? And for companies to be as competitive as the global companies, you would require that new job to come at lower wages. If you want to become a factory again, then your point of advantage isn't your consumption ability, which the US has now, but your production ability, which as businesses need. And to strengthen the businesses, you need to cut their costs really down so their products are competitive worldwide. So we can get there if all of our salaries are dropped by 60-70%, so our companies can produce stuff cheaper.
Well, and tell me, Rabih, if I'm thinking about this incorrectly, kind of this a crude, simple understanding of this, but is that theoretically kind of what is, again, we're trying to decide or split between the theory of this versus the actuality of what's going to happen. But isn't the theory of the tariffs to make those goods, like make the foreign, like the American consumer going to foreign sources or businesses going to foreign sources less attractive, and coming obviously to the US, and not necessarily forcing us to lower the costs of goods or the cost of labor, but actually increase it, even if it's like, again, in alignment with those. So it's basically saying like, well, I'm going to pay for foreign goods with this tariff. It's going to be X. It's going to be this expensive. I might as well do it in the U.S. and it's going to be equal, which actually could raise wages and raise the cost of goods.
100%. So instead of it actually making U.S. businesses on an absolute term more competitive, aka their prices are competitive, the rest of the world would want to buy American. What tariffs are doing is that, in kind of a basketball terms, just boxing out the competitor. So the U.S. consumer is kind of indifferent between buying American and buying non-American. But for the rest of the world, they're still going to buy from the non-American because they don't have tariffs there. So a tariff is literally raising prices on your own citizens in textbook manners. So, which is interesting because now we are in a situation where we are consuming 30% of the global production. To be able to continue to produce, and think of it that way, every single time you buy something from non-American, from the foreign countries, you are taking in their product, but you are giving them your money, right? To do so, you need to support the fact that you are the largest consumer in the world. You have to consistently run a trade deficit. That's because the US is a reserve currency. If the US was not a reserve currency, you could say, I'll just shut it off. I'll try to balance the trade. But if the US is a reserve currency, there is another side of the argument, which is if you are a reserve currency, and that's important for economic goals, national security, etc., you would want to keep providing the rest of the world with that currency because it's the reserve.
Yeah.
So the whole idea comes from something called the Tariff dilemma that showed up back when Nixon was in office, talking about the dissociation between the US and gold during the Bretton Woods system. But the Tariff dilemma, in a sense, is summarized as such. You have two opposing forces that create an equilibrium. And this is where the idea of a ceiling comes in. The first force is, if you want to protect domestic industry via tariffs, the desired effect is that you want to reduce imports and kind of get rid of the trade deficit. But the opposing force is that it's going to undermine your global dollar liquidity because you are not giving money out, because you're not buying those foreign goods. But if your goal is to maintain dollar hegemony, aka keep the US dollar as the reserve currency, then the desired effect is to keep trade deficit, because this is the mechanism through which you maintain a reserve currency. Yes, you can be politically very strong and have the strongest economy, but if you do not implement that through a continuous trade deficit, you cannot logistically transfer the money out. That would be your desired effect, to keep trade deficit and dollar outflow. The opposing one, it's going to be contradictory to protectionist policies such as tariffs. So we can, and to just summarize this, given the system that we're in, we are in a system where you are 30% of the global consumption as one country.
Which, by the way, that's number one, right? Is that correct?
That's number one.
Yeah. Okay.
And number two, you are also the reserve currency of the world. So you can keep putting on tariffs, trying to balance the trade until you get to a territory where the rest of the world does not have enough US dollars and the US dollar is losing its standing as a reserve currency, that you would want to revert back to balance between these two factors, because both are national interests. The first national interest is what the Trump administration is running on. We need to make domestic policy more competitive. We need to balance the trade to be able to balance the budget, etc. But at the same time, we know that the Trump administration wants the USD to stay the reserve currency, because even more comes with it. And those, because the key to them is trade policy, is deficit, can go either way. And that's where the balancing act, the equilibrium, happens. My hot take is that we tilt more towards maintaining the reserve currency rather than fixing the domestic industries. And I think of it that way. We are 30% of global consumption. And that is just structural thing due to the American consumer position in the global economy. If we decide to just stop trade right now, we are not solving the solution. If you are 30% of the global economy in terms of consumption, just putting on tariffs is not going to solve it. It's like you have sciatica pain and you're stretching your hamstrings. Like, what will that do? You need to do more. You need to structurally change, the underlying infrastructure. You have to move the US from a consumer country to a producer country. And how feasible is that? This does not happen in one administration. This happens over a generation. So that's why I'm more inclined towards the idea that, yes, it might work for a year or two, but we'll have to get rid of them at some point, and we have to go back. Because the system says, based on the size of your economy, the size of the US consumer vis-a-vis the world, you're always going to naturally drift to being in a trade deficit, the spender, the provider of USD for a reserve currency.
Yeah, there's a lot there, but it's good to see the numbers. I guess my question, Rabih, is this an all or nothing thing? So meaning you're saying it's impossible, really, based on what you're describing here, to get rid of the trade deficit entirely. But
forever.
Is it still like one of those things where it's like, again, is it all or nothing, or is it like the improvements in adjusting down the trade deficit is still a positive thing? Or are you saying kind of like, this is still just kind of posturing, it's not going to matter once Trump's out of office, we're just going to revert back and get rid of the tariffs and all that?
No, good question. What I'm saying impossible is that if you set the game under these rules and you let it run, it is impossible, because the US consumption is always going to overpower the rest of the world and will put the US in a trade deficit. But what I'm saying is, like, naturally, if you let it run, the economics of things will bring us back to where we were.
Yeah, it doesn't work, yeah.
So on the long run, it's definitely impossible. Can you do it for a year or two for political win? Sure. You'll have to balance the risk between putting the world into a global recession versus the political win that you get internally. It is possible. It can happen for a year or two. Will the benefit that is reaped in those 2 years good enough that resets the track to the US being on a more fiscally responsible path? We do not know, because as you said, going full circle, going to that article, they're arguing whether all these tariffs, 20% on the 3.3 trillion of imports that we do, that will probably raise $1 trillion at best, 600, 700 according to other economists. Will that inflow in with all the inefficiency that it creates in the natural flow of economic progress be enough to set the US on a fiscally responsible path? Big question marks.
Yeah.
So there is an underlying infrastructure that tells you what you're doing works, but it is being implemented with brute force against the natural flow of the monetary system. So how long can it stay?
Yeah. Well, and to your point, we're talking about a generational shift to change the ecosystem we live in, not necessarily like meaning the behavior of a whole generation or a whole people has to change for this to actually, to shift from a consumer economy to a production economy, to your point. That is not something that happens in a 4-year span.
Yeah.
And I wouldn't even begin to know like the catalyst for that shift. Is it like we shift the economic structure by lowering the deficit, tariffing or putting tariffs on imports, and all of a sudden the behavior of the entire American population starts to change? Like, probably not.
No. Can you imagine? Because we were a producer economy in the early 1920s, right?
Yeah.
Before the Great Depression. Can we go back to that lifestyle where people are just working? We got spoiled. That's how I think it is.
Yeah, well, even post World War II, I think we were a massive production economy just due to the war.
Yes.
And it is interesting. You think about what like Trump's messaging has always been is like get back to those days. I think he's referring to like post World War II, industrial revolution, production type economy. But the dynamics now are just so different.
Yeah, I think personally that the ship has sailed. So the only way we can grow back is through new innovations. Like, you're not going to be able to create a more efficient car factory, no matter how much tariffs you put. But will you be able to create the most efficient, most competitive chips warehouse? Data center? Probably. So it has to be a balancing act. But at least, like, running through this analysis, it doesn't give you an answer, but it kind of tells you what will not happen. tariffs are not going to just run rampant forever. We're not going to get to a point where we have 60, 70% tariffs, because at that point, it'll be so obvious that the damage to the US standing, especially from a reserve currency perspective, is going to be too big to bear, right? It is going to tell you what's not going to happen. What's not going to happen is that it's imposing tariffs, given that such an impact has, a downward pressure slowing down a global economy, is not going to help the US become a more fiscally responsible country going forward. This is not what's going to happen. What will they do? Still, a balancing act, politics, economy. At least this type of analysis eliminates the extremes that a lot of market participants, especially in last week's sell-off and this week's sell-off, have been freaking out.
Although, is it selling off? I saw today, last I saw, markets were up quite a bit.
Just today. Yeah.
Today.
It's usually buy on the rumor, sell on the news, but it's because negative pressure. They've been selling on the rumor, and now they just bought on the news.
Got it.
More to come. More to come. Yeah.
Also, are we going to sit here and get breaking news on the, it's coming out on Saturday, but I just saw a thing pop up, Rabih. Trump tells Inner Circle that Musk will leave soon. Musk is leaving the administration. Yeah, Trump told cabinet that Elon Musk will leave administration in coming months. That just popped up as we were talking. So
we'll talk about it next.
We'll talk about it next time. This is Wednesday. This will be old news, most likely, by the time this actually is released on Saturday. So, but that literally came as we were talking. So that's interesting consequences to come. Does that mean Doge is dead? Who knows? Okay, Rabih, anything else on tariffs or your hot takes?
Actually, given that Doge is here, now if you impose tariffs, just going off what Elon Musk's news is, if Doge is, not going to be there anymore, we do not really care about the budget deficit, what's the point of having a balanced trade right now? Like, what are you going to do with all the money that's coming out of the tariffs?
Yeah.
That's going to be interesting.
Well, you kind of wonder what this leads to with tariffs and what's happening behind closed doors with these negotiations. I still fully believe that just as a normal citizen with an average brain, I still fully believe that a lot of this has been posturing from Trump and pushing, and in the background, a lot of like negotiations have been had, trying to renegotiate trade agreements and all that kind of stuff. Maybe this is step one of getting, Elon leaves, and all of a sudden we see the domino effect of how this impacts tariffs moving forward. Who knows?
We'll wait and see.
We do bust strikes here. Maybe we're going to bust the tariffs as well as we talk about it. Okay, that's awesome, Rabih. Let's jump to some lighter topics. This is usually when everyone tunes out or turns off post Rabih as we jump into some of the
Today
other
was
stuff.
heavy. I have to.
Today was a lot, which is good. I just came across this interesting article. We talked about this last week about income, right? I think Jake brought the story, or just the idea of like what's a lot of money now, or what's a living wage, I think is how he referred to it. I think I came across this. It's kind of in the same vein from one of my favorite writers. His name is Nick Majuli. If you've not seen him or seen his stuff, he's really great. He writes a blog called Of Dollars and Data. He's awesome. But he wrote an article a while back, a few weeks ago, whatever, around, is $1 million still a lot of money? I guess, Rabih, I just want to get your first take on that. If you hear that, is $1 million still a lot of money? I just want to get your first response.
I will say, where are you living?
You're on it. You're so smart. To you right now, $1 million is $1 million in investable assets a lot of money?
At my age, where I still have a lot of,
you keep asking for context, Rabih. Let me repeat. Is $1 million a lot? Is $1 million a lot of money? No. Interesting. You say no. Okay, that's okay.
Yeah, I'm taking the average person who they want to get the $1 million and not work. For me, because I want to continue working, I'd say, yeah, it's really good. I'll take it.
Yeah.
But
yeah, my first response is still, I'd say yes. My default would say yes. Like if it had someone has $1 million on a brokerage account, let's say, because we have to define this too. So this group, Gemini, I can't pronounce this. Anyway, they did this study. They said 7.4 million millionaires in the U.S. as of 2023. But we got to get specific. They defined a millionaire as someone who has $1 million in investable assets.
So not a house.
So not a house. $1 million in investable assets. So they said 7.4 million millionaires in the US as of 2023, but specifically that's investable assets. So the typical millionaire household has roughly 30% of their assets in their home. So this actually means that many of these millionaires, according to the study, likely have over 3 million or more in total wealth.
Mm.
So, but if you were to ask me, I'll ask myself, Matt, is $1 million or no? Is so without context, if you just said someone has $1 million in a brokerage account, I still say that's a lot of money. Is it what it was before, like 10, 20, 30 years ago? Of course not. In fact, I'll give you some data here. So he references this in the book, The Millionaire Next Door. This was written in 1996. So since 1996, basically, $1 million, like what was a dollar or what was $1 million back then, is $2 million today.
Adjusted to inflation.
Adjusted for inflation. That's kind of how I look at it. Like we were talking last week about, again, this income situation of like what's a living wage. And you're right, it depends on where you live with income. Same thing with wealth. So like if you're comparing $1 million in LA or you have $1 million in New York or Hawaii, apparently, that's not that much money. If you're in the Midwest and you have $1 million, it's just a fact. Like the cost of living there is much lower compared to these other, like again, California and New York. That's still, I think, a decent chunk of money. Like, is it financial freedom money? It depends on the person. Probably depends on if you're living on rice and beans or not. But so 90. Oh, go ahead, Rabih.
No, I was just gonna say if you're only gonna withdraw 4% of it, going off the 4% rule, that's 40 grand a year.
40 grand.
Can you live on that? How many households? How many people in the household?
Yeah, exactly. And I'm glad you said that, because why did this just pop? Oh, sorry. I just got a call.
We're having data issues today.
We are having data issues. So yeah, I think that's a really good thing to be thinking about there. I like that you just said that. Like you think of withdrawal strategy. I always tell people this, a really easy rule of thumb, 40,000 per million. So you have $1 million, 40,000 in income. Like you said, if you've got 2 million, you got 80,000, 3 million, 120, so on and so forth. I think just putting this in the context of a dentist, I have this happen sometimes when we speak places and someone will say like, how much do I need to retire? I know nothing about them, nothing about this dentist. And we've talked about this on a podcast before. If a dentist walked up to me on the street and I know nothing about them and they're 45 years old, how much do I need to retire? I'd say at least $5 million, at least 200 grand in income. That aligns with our average client spending about $200,000. So, but to your point, he talks a lot about in this article. Depends on where you live, for sure. Here's an interesting point, though, I think that I want to highlight here and get your thoughts on. So relative wealth versus absolute wealth. So specifically, $1 million we've already established, just based on the numbers back in 1996, is about $2 million today. However, if you talk about the quality of life we have today, so he poses a question. Rabih, would you rather have $1 million in 96 or $1 million today?
I see where this is going. Yes, I would choose now.
And tell me why.
Okay,
tell me more.
Because while $1 million right now cannot buy me more stuff, the amount of improvement in my quality of life since 1996 till now is more than what $1 million can buy. You know how the average American's life has changed over since 1996, so 29 years. If you just traveled back in time to 1996 and said, here, I have $1 million, I want to spend on stuff that allows me to live the lifestyle I live right now in 2025, $1 million is not going to be enough. We're talking about better healthcare, better transportation, more connected world. Where 1996, you want to video call someone, you can't. So how much are you willing to pay in 1996 to video call someone? The $1 million at that time will not be enough.
Yep, exactly. That's exactly how I feel about it too. And he mentions that in this article, and I totally agree with it. Again, the absolute versus relative matters. I think I'm with you. I'd rather have $1 million today than a 96. Although I do contend the 90s was the best decade, just for the record. So just for quick numbers here, I just, again, thought this was kind of fun. $1 million today puts you in the top, just inside the top 20% as far as wealth. Mm-hmm. In 1998, you would have been in the top 5% of wealth. So he calls it the millionaire middle class. It's just becoming less exclusive to have him to be kind of a quote unquote millionaire. I do think, and this is just kind of a testament to probably natural innovation and growth of an economy, I'd imagine, right, Rabih? Like we talk about just how big the U.S. has become economically, how mature we're becoming. I think again today, what used to be the millionaire is probably now the multimillionaire. 2 to 4 million is the new millionaire, which again I think is just a result of what happens to an economy as we get to the level and size that we are. So anyway, I just thought it was fun. I think it's an interesting topic to talk about. Obviously, with our clients, all of our clients are or going to be millionaires. They're well on their way. I think if you again apply this to dentists, because they're just a level up from the average citizen in regards to how much money they make, how much wealth they can build. Again, even more so for dentists to say you're a millionaire, that doesn't mean much to most dentists. I bet most dentists, based on my conversations, they're going to be like, if I ask them that question, is $1 million a lot? They're all going to say no. I think for them, it's like $5-10 million is from my perspective. But Rabih, any other thoughts or comments on this? Any hot takes on the millionaire question?
Yeah. You want to hear a portfolio manager tell you money doesn't matter. It's about what you do with it.
Yes, I do.
I resonate with that more. It's like the absolute number doesn't really matter. It's really what you're going to do with it, what type of life you're going to have with it. Although what I do for a living is try to make people more money.
No, I love that. And he actually mentioned this, and we can finish this section with that, is just kind of checking your mindset. We talk about this all the time. I just heard a podcast on Chris Williamson's show, Naval Ravikant. He's like one of my favorites. He's amazing. But he was the first one that put me on this idea and really put words to this thought around wealth versus status. We've done a full podcast on this of what are you buying? Are you building wealth? Are you chasing status? And Nick talks about this, that a million, to your point, there's not only absolute wealth versus relative wealth, right? There's also this idea of, is this a status game for you or is this a wealth game? And you just said it, exactly what he mentions in this article of like $1 million today is not going to feel wealthy if you're playing that status game and you're comparing, right? If you're just looking at the absolute numbers compared and you're like, does this buy me status? No. But if you're defining it more as that freedom, the peace, the optionality, what it's the tool in your life of what it's doing for you, again, I still contend $1 million is a lot of money. It all comes down to how you use it. So I'm glad you went there, Rabih. Any other thoughts on this before
I
we
love it.
wrap up? We always go from like economics, tariffs, deep dive into the economy, and then we like to bring in this mushy gushy stuff. It's how we roll.
Life, philosophy,
life and philosophy. Yeah. I'd much rather talk about those things in most cases, and I know you would too. You and I have had some deep philosophy conversations. Okay, last thing, Rabih, you and I both saw this and we were like, we've seen the title, but we haven't read the article. We're calling ourselves out here. But I did think it was interesting. And I want to make a point on this, but the article is 60-40 portfolio may no longer fully represent true diversification. This is from BlackRock CEO Larry Fink. For those of you that don't know BlackRock, they are the biggest asset manager in the world. I don't know how much money they manage, Rabih. It's in the trillions.
Yeah, much trillion.
Biggest by far. He says, instead, the future standard portfolio may move toward a 50-30 with stocks, bonds, and private assets like real estate, infrastructure, and private credit, Fink writes. Rabih, I know you got thoughts. One thing I'm going to say, just like the value premium, I've been hearing the 60-40 portfolio was dead for I can't even tell you how long. So, what are your thoughts, though? I know you got thoughts on this.
This is one of these topics that even before you hear the other person's argument, you already have talking points because it's been discussed so many times before. The idea of a 60-40 portfolio is that during a recessionary environment, you would expect a monetary authority like the Federal Reserve to intervene, cut interest rates, and appreciate the value of your bonds that you can then rotate them back into your equity and kind of avoid a downside. And during times when there's an inflationary period, you're going to be losing in real value on your bonds, but your equities, due to the pricing power of companies, can overcome the inflationary period and appreciate nominally that it would balance. And on the long run, if you keep rebalancing your portfolio, you should do better than one asset class. This is the argument. It kind of was called dead due to the decade between 2010 and 2020, where both bonds and equity did well, but equities did so well, incredibly well, US equities, that you didn't really need a 60-40 because you'll be making less than just being in the S&P, for example, right? The 60-40 is one path toward diversification. The diversification is about adding uncorrelated asset classes. That's where the idea of adding real estate, private equity comes in. There is no right answer because we do not know what the new economic regime is going to be. And it really depends on the economic regime to understand what's the best asset class. 2025, the best asset class has been gold, simply because we've got lots of political and economic uncertainty. This does not mean that going forward, a 60-40 or equities, just because they're down this year, are dead. It really depends on the regime that's coming, and we do not know what the regime is going to be like. That's my hot take on it.
Holy cow, Rabih, I knew we would have some good stuff on this. One thing that I want to reference, and this is in no way me sitting here and being like, Larry Fink, you don't know what you're talking about. Not at all. But when I see this article, I just think it's an important distinction to make around when it says the 60-40 portfolio may no longer fully represent true diversification. My take to that is if we just think fundamentally about investing, referring to 60-40 is not referring to diversification. It's referring to asset allocation. That seems like a simple, like, again, trying to call him out like you don't know what you're talking about. I'm not doing that, but it is a huge difference. Like asset allocation, your mix of stocks and bonds or mix of assets is extremely different than diversification. And I just think this is an opportunity to highlight that. I'll give a quick example. A guy had this all the time at Fidelity when I worked there, a whole nother life. People would mix these two concepts up and they would say the two things that would happen a lot to me, Rabih, you'll get a kick out of this. People would say, yeah, I've got the right like asset allocation. And I would look at their portfolio and they've got Apple and Netflix and then like a couple of bonds, right? I mean, I'm using an extreme example, but this would happen a lot. And they're like, yeah, I'm 80-20. And I'm like, well, okay, you've got maybe the right asset allocation because that just means this broad category of stocks, broad category of other assets, bonds, let's say, but you're not well diversified. So the way I phrase this sometimes to people is asset allocation is like your offense and your defense. Diversification is the different positions on the team. You might have a team full of Tom Brady's, right? Just a bunch of quarterbacks. You might have the right killer quarterbacks on your team and have the right, again, allocation, but you don't have the right positions on the field, which is what diversification is. Is that pretty, Robbie, did I nail that?
I love that analogy.
Thank you. Freaking nailed that.
Yeah.
So I wanted to highlight that, again, more of a learning opportunity for everyone out there of just saying, that's a huge difference, right? The other thing I would hear, Robbie, a lot, which is this is funny. I would hear this a ton. People would say, no, I'm well diversified. I've got an IRA at Schwab. I've got a brokerage account at Fidelity, and I've got this other account over here. And I'd say, oh, like, what are you invested in? All Apple. And I'm like, they would think the diversification was where they were investing, not what they were investing in. The other thing I want to mention here, as we wrap this up, is I actually saw this and I'm like, this is actually really cool when we talk about dentists. So he says that if we're talking about like a fully kind of optimized portfolio being 50, 30, 20, again, stocks, bonds, private assets like real estate or infrastructure, whatever. When you talk about a dentist, especially a practice owning dentist, it is really common. Well, let me back up. There's really only 3 places you can invest, right? We highlight this all the time. Public markets, private markets, and then real estate. That's really it. Those are the 3. Underneath those broad categories are a lot of different things. But if you look at a typical dentist who's owning their own practice and let's say owns their building and then their home, if you were to take a pie chart and break this down, which we do this all the time, we build out a balance sheet, we turn it into a pie chart form and we show them, here is how your allocation is broken down with your assets. Early on and throughout even mid-career, it is really common that a dentist has a huge chunk of their assets in private equity, which is their business. They should be treating it as such. And then real estate, practice building, and then maybe some other pieces, personal residence, or maybe they have some rentals. So if you really think about your total portfolio, this is why we believe so much in public markets and dentists going so all in early and often and for quite a while into public markets, into the stock market. Because if you look at the total of your portfolio, you could do that for the next 10, 15, 20 years and still not be fully balanced into this, what Larry Fink calls the optimal portfolio. So I actually think this is really, really cool, and why we advocate for dentists. Yes, be putting as 15, 20, 30% of your free cash flow into public markets to even this out.
100%. This
Robbie,
really
thoughts?
no, I like it because it highlights on the value an advisor adds, because not all investors are the same. It really depends on your situation. And a dentist is someone, due to the nature of their work and the risks in their work, they are already over concentrated in real estate and private exposure. I like it when dentists come to me, it's like, I want to do these strategies in private markets, etc. I'm like, great, but I wish you were a math teacher instead, because then it would apply more than you being a dentist who on their balance sheet has a practice and has real estate related to that practice on top of their houses. So the goal is to put you in the proper diversified, the proper players on the field. But we're starting with your roster that is only real estate and private companies. Once you get to a certain size, yeah, we can be very creative, but there are some certain first steps that should be done when you start.
Love it. Yeah, generally speaking, first decade or more of your career, you should be going all in on a fundamental, foundational portfolio, globally diversified, mainly in equities. There's probably not a ton of reason to even own bonds. So this is not investment advice. This is, please consult with your professional. Okay, Rabih, this is great. We killed it, I think. I'm going to say
it
it.
was great.
Yeah. If we, did I just give us a shout out and say we killed it? I think we did. You killed it. I was here.
It was great. We talked about, let's not get our heads into the air. There are limitations for how tariffs can go back and forth. We also talked about what $1 million mean to you. And we also talked about what it really means to be diversified. If you took anything out of this,
Rob, you just gave a summary.
Yeah.
You just gave a summary. I love this. Speaking of diversification, I think one of the things you should be diversifying is just like the activities in your life and the places you go and the places you see. And one thing that I think is certainly underweighted in people's lives is probably the Dentist Money Summit. Not for the amazing people that are coming, but you should probably, if that's not in your activity portfolio in the next few months, you should add it. I think you should add it. And the return on your life will be much higher. Studies show. Rabih, did you see that study? Did you see that study that was put out there?
Studies show.
That studies show that your life will be greatly improved. The return on your life will be greatly improved if you come to the Dentist Money Summit in Park City, Utah, June 20th and 21st. I have heard all the coolest dentists are coming. I have no idea. I can't confirm that, but chances are that's going to be the case.
It's trending. It's trending.
It is trending. It is trending for sure. It's trending on the Dentist Advisors Facebook group that you should be coming. We'd love to have you. DentistMoneySummit.com. Check it out. Rabih, thank you for being here. Everyone, thank you for listening. As always, that was our 2 cents. Until next time, bye-bye.